Managing and investing a $100 billion fortune, strategies, responsibilities, and case studies. Introduction. Managing a $100 billion fortune presents unique opportunities and challenges. At this scale, wealth rivals the GDP of small nations and requires institutional level strategy. In recent years, a handful of individuals, mostly tech founders, have reached or exceeded this milestone. With great wealth comes the need for sophisticated investment strategies, prudent wealth management, philanthropy, and personal responsibility. This report explores how an ultra-high net worth individual might effectively manage and invest $100 billion, covering diversified asset allocation and risk management, wealth management best practices, family offices, tax and estate planning, philanthropy at scale, lifestyle and security considerations, personal and societal responsibilities, case studies of individuals and families who have stewarded fortunes at this scale, investment strategies at the ultra-high net worth level. Effectively managing a $100 billion portfolio requires diversification beyond the traditional 60-40 stock bond model. Many ultra-wealthy adopt a core satellite approach, a stable foundation of blue-chip equities and bonds, plus satellite investments in private equity, venture capital, hedge funds, and alternative assets. Example, allocation for a $100 billion portfolio. Public equities, approximately 40%/$40 billion. Global stock holdings for long-term growth, dividends, and exposure across industries and geographies. Fixed income, approximately 20% per dollar, $20 billion. Government and corporate bonds for stability and income. Municipal bonds are often used for tax advantages. Or private equity and venture, approximately 15%/$15 billion. Stakes in private companies, venture capital funds, and buyouts. Wealth at this scale allows access to exclusive funds and direct deals. Real estate, approximately 10% per $10 billion. Commercial properties, prime residential, hotels, and land as income generating and inflation hedging assets. Alternatives, approximately 10% per $10 billion. Hedge funds, commodities, infrastructure, fine art, and collectibles, all offering uncorrelated returns. Cash and equivalents, approximately 5% per $5 billion. Liquidity for opportunistic deals, philanthropy, and operational needs. At this level, wealth management resembles running a global institution, hedging currency risk, scenario planning for extreme events, and deploying liquidity strategically. Billionaires also tend to hold large concentrated stakes in their original companies while diversifying new capital elsewhere, e.g. Arnault in LVMH stock, Bezos in Amazon, Buffett in Berkshire. Wealth management best practices. Managing $100 billion goes beyond investing. It requires legal, administrative, and strategic structures. Family offices. Most billionaires operate single-family offices, SFOs, private organizations that handle everything from investment management to concierge services. Staff often include CIOs, portfolio managers, accountants, tax lawyers, and even teams dedicated to philanthropy and personal security. Operating budgets may run into tens of millions annually, but this is cost-effective relative to external management fees. Tax optimization. Tax strategies at this level can save billions. Common approaches include buy, borrow, die, hold appreciating assets, borrow against them for liquidity, loans aren't taxed, and pass them on with a stepped-up cost basis at death. Trust and estate planning, dynasty and generation skipping trusts minimize estate taxes and preserve wealth across generations. Charitable deductions. Donating appreciated stock avoids capital gains tax and yields deduct. Billionaires often set up private foundations, donor-advised funds, or philanthropic LLCs to combine giving with tax efficiency. Estate planning. Decisions around inheritance vary. Many billionaires cap children's inheritances, e.g. Gates leaving less than 1% to heirs, while pledging most wealth to philanthropy. Others prioritize multi-generational dynasties, e.g. the Waltons. Education, governance, and staggered trust distributions are common to prepare heirs responsibly. Philanthropy, giving at scale. At $100 billion, philanthropy is both expected and transformative. Vehicles include private foundations, long-term, mission-driven entities with endowments, e.g. Gates Foundation, donor-advised funds, low-cost and flexible accounts for ongoing charitable distributions. Philanthropic LLCs, flexible vehicles for both charitable and for-profit social ventures, e.g. Chan Zuckerberg Initiative, direct giving, one-off donations, or funding major projects directly. Philanthropists at this level can influence global health, education, climate, and poverty. Many commit to the Giving Pledge, promising to donate at least half their wealth. Some adopt giving while living, deploying large sums during their lifetimes to maximize impact. Lifestyle considerations. Extreme wealth transforms lifestyle in profound ways. Residences, multiple estates worldwide, often including compounds for privacy and prestige. Travel, private jets, yachts, and occasionally ownership of sports teams or even space ventures. Collectibles, art, rare cars, jewelry, and wine collections double as investments. Security and privacy. 24/7 security teams, gated compounds, private ownership structures, LLCs for property, and extensive cybersecurity. Public image. Billionaires face constant media attention and scrutiny, requiring PR management. Relationships, wealth can complicate family and social dynamics. Many invest in heir education and governance to avoid entitlement or conflict. Responsibilities and risks. Personal responsibilities. Stewardship of assets and businesses that impact thousands of employees. Educating heirs and preventing wealth from eroding family values. Using influence responsibly, given the ability to move markets or sway public discourse. Societal responsibilities. Funding innovation and public good initiatives. Ensuring ethical business practices and fair wages, and supporting democracy by avoiding undue political influence. Risks: security, kidnapping, extortion, and cybercrime. And reputation, public backlash for excess or missteps. Legal and regulatory lawsuits, antitrust, and taxation. Societal: wealth inequality may trigger political instability or wealth taxes. Bottom line, extreme wealth comes with both privilege and scrutiny. Acting transparently and generously mitigates risks. Case studies of Jeff Bezos built Amazon fortune, diversified via Bezos Expeditions family office, The Washington Post, Blue Origin, and real estate. Launched the $10 billion Bezos Earth Fund for climate change and Day One Fund for education and homelessness. Increasing focus on philanthropy to shape his legacy. Bill Gates transition from Microsoft to Cascade Investment, a diversified family office managing stakes in rail, waste, hospitality, and farmland. Gates Foundation has granted over $100 billion to global health and education, intends to donate nearly all wealth, leaving modest inheritances to heirs. Walton family, collective wealth of $300 billion plus, controlled via Walton Enterprises and trusts. Investments include Walmart stock, banking, infrastructure, and philanthropy through the Walton Family Foundation. Legacy secured through early estate planning and family governance. Bernard Arnault built and controls luxury empire LVMH. Family ownership safeguarded through partnerships and succession planning. Group Arnault invests in tech startups and real estate, diversifying beyond luxury. Philanthropy centered on arts and culture, e.g. Fondation Louis Vuitton, Notre Dame donation. Elon Musk, highly concentrated wealth in Tesla, SpaceX, and new ventures, little diversification. Philosophy, wealth as fuel for innovation. Sustainable transport, space exploration, AI. Limited philanthropy to date, but has pledged to give away most of his fortune. Warren Buffett, fortune tied to Berkshire Hathaway stock, invested conservatively, and grew wealth steadily. Donated over $50 billion to charity, mostly via the Gates Foundation, lives modestly and plans to give 99% of wealth away. Conclusion: managing $100 billion is akin to running a nation's balance sheet, requiring diversification, liquidity, and institutional level governance. The most successful billionaires pair financial stewardship with philanthropy, legacy planning, and ethical responsibility. Case studies show multiple approaches. Bezos and Musk channel wealth into bold ventures. Gates and Buffett prioritize philanthropy. Arnault and the Waltons emphasize family control and continuity. Ultimately, effective management of $100 billion is not just about preservation or growth, but about aligning wealth with purpose, whether advancing science, addressing global challenges, or building multi-generational legacies.